Market observations for Adelaide, South Australia. Now today we're taking a deep dive into the Salisbury local government area. This is just north of the CBD. It's an area that over the last few years we've purchased extensively within, up to over 100 properties purchased over the last few years in and around this area for ourselves and clients. Obviously some great fundamentals, some really positive things occurring, but have we missed the boat? Now, just to clarify, we have been requested to cover Adelaide and individual local government areas within by you, our audience. This is not an area, as a disclaimer, that we're currently actively buying in for ourselves and for other clients as an advisory firm, but it is somewhere that we're very comfortable with the fundamentals going forward. But this is an investigation into if we wanted to buy there, if we had a gun to our head, could we and how would we do it? Look, let's dive into the information that we have here, take this deeper dive and really work out how we could make this opportunity work for ourselves. What are the positives? What are the things we need to look out for? And, to confirm, have we actually missed the buying window or is there some opportunity for us? So let's dive in. Property investment is a science. Okay, there's lots of arts components to this or art components to property investing. That's true. There are a lot of softer elements, but the fundamentals of finding good investment areas is a science. Okay, there's a lot of information, a lot of data, a lot of science that goes into how we find and research areas to purchase investment properties within. We break this fundamentally down into demand versus supply. It's a market dynamic like any other market. Demand, we've got some demand creators and some demand amplifiers, employment, new projects, lifestyle and population. This forms an overall demand or improves people's willingness to pay for properties. Supply is new housing, so new residential supply coming into an area. We could have a wonderful, suite of wonderful things going on in an area, but if there's many hundreds of new houses being built, then that supply is matching or even outstripping the demand, and we're not really going to see strong price growth. It's the simple fact of it. So we see, as property investment as a science, demand minus supply equals the opportunity. So let's break down these individual elements for the city of Salisbury within the city of Adelaide. Right, the market opportunity to begin. Industry sectors. With employment, we like to see obviously unemployment rates, we like to see income growth, and we also like to see the diversity of employment. It's very important. We don't want it to be a one-horse town. We don't want the mine to close down and no one's got a job. We like to see nice, strong, diverse employment. Here, as we generally see in a capital city, we have diverse employment. The highest, it is a middle tier area within Adelaide. We have a lot of employment around manufacturing and public admin, some retail and trade. This is a very diverse employment landscape. When the largest manufacturing only has 15% of the share of all employment, that is extremely diverse. As a national, we see some local government areas across the country with 60 or 70% of people in the one job type. This is extremely diverse and stable employment. Unemployment rate. It is oscillating here. Obviously through COVID, things have been impacted, all right, but we are seeing it at the high end of the scale at the moment, all right? We're seeing around 8% unemployed. That's high on a national average. Remember, as I might skip to in a moment, Adelaide traditionally has always had very low population growth. It's not a population growth story. It's a very old money, established, type of area. We generally don't have a lot of population moving towards it. It's a beautiful city with excellent infrastructure. The town is impeccable, or the city is impeccable, but you generally don't have a huge amount of people moving there. So it does rely on very strong employment, which it traditionally has had. Okay, but we can see this has oscillated throughout COVID, and at the moment, this is probably not necessarily that acceptable. 8% unemployment rate is quite high. All right, so that's probably an asterisk and a risk factor for Adelaide at the moment. it's not something where we can rely on 3 or 4% per annum population moving to an area and we can get away with that higher unemployment figure. We don't have that in Adelaide. Traditionally population growth in this local government area and also across the broader Adelaide area is around that 1%. All right, so that's not where we're getting the demand from, right? Let's have a look at the combination between the demand and supply. So this is probably more at a more granular level now, which is taking a deeper dive into the actual on-market dynamic, right? So this is where we might consider where the supply is coming into a market and how that is impacting the demand, and do we have equilibrium? Now, I just wanted to probably mention before we dive into that, if you're looking for some clarity as a property investor, if you're wanting to invest, you understand the fundamentals of property investment, but really wanting some clarity about what to do next, then please take the opportunity to book in a free 60-minute wealth consultation with one of our wealth advisors, a qualified investment property advisor, and we'll be more than happy to put together a no-cost 20-year wealth plan for you. It's about moving those chess pieces around, seeing which types of properties are going to move you closer to your goals most effectively. If you'd like to take us up, then please book in a session. There is a link below this video for you to do so. So with the purchase analysis, let me jump back in here. This is now when we're starting to see the outputs between demand minus supply. This is reading the tea leaves. This is the on-the-ground dynamic. It doesn't lie. The data doesn't lie. This is actual people doing human things, okay? Talking about property, buying property, inspecting properties, and then actually transacting. This is the data on the ground that represents the market activity today. All right, and this is where we understand, the macro is great to get context, but this layer of data really gives us an idea of, is this a buying point or have we missed our window? The first metric I'd like to look at is days on market. Okay, days on market is a primary metric, and I'll come back to that in a moment. What I mean by primary is it is directly related to the on-market activity. It's the time it takes a property to sell from listing to it becoming unconditional. All right, we can see in this case we've got other, which is the blue line, houses, which is red. The majority of people target houses or prefer to live in houses in the Salisbury LGA. So this is what we prefer to focus on today in our investigation. And we've had a very steady, over the last 12 months, a very steady decline in days on market. Now, 20 days on market is effectively about as low as you can go. Right, so a property is listed, you have a very short negotiation, maybe one open home, you have offers being made, you have building in pest clauses expiring, you have it going unconditional. 20 days is about as low as you can go. So right from the beginning we can see we've got an extremely constrained market. We've got a lot of a tightness in this market and a very efficient turnover of properties. We can see this once again reiterated somewhat to the competition. So the percentage of immediate sales. So this is how many properties are being sold within the first week of listing. Now this is capturing off-market listings. This is capturing those that are almost selling without even going through an open home process. You need to have a market, the fundamentals all need to align for this to even be possible. And sometimes we see through this Christmas period, it's just not possible. People are not inspecting homes, sales agents are not getting back to people, they're on holidays, etc. We can see here the market was high, extremely high competition around August, September, and we are seeing, I have had the luxury of skipping ahead on these slides, we are starting to see this ramping up. So I would expect, once again, extremely high competition in the next month or so in the Salisbury area. So at the moment we're around the national average. Remember, we've gone through a Christmas period where it is more difficult for properties to transact. So this is emerging as a very bullish signal, which I'll come back to. Stock inventory, same story, once again reiterated. Number of properties available for purchase. Okay, this has been consistently dropping. Remember, houses now in the red. It has been now consistently dropping for 12 months. All right, we are down to extremely low, unprecedented stock levels in this local government area. When a property is listed, it has a lot of eyeballs, a lot of interest in it, a lot of demand is focused on a very small number of supply. Remember, Salisbury is an established area as well, vast, mature area. It doesn't have a huge opportunity for new subdivisions. We don't have the large 1,000-lot estates being opened up into this area. It is very well established. Sorry, stock inventory, I'm just going to skip forward. So this is now a secondary measure, and it's actually, from our research, very closely correlated to price growth. This is a very strong and important measure in predictive analysis for property price growth. And it is a secondary measure, so it is a combination of days on market and the stock inventory. All right, so days of remaining supply, we are now down. It has just turned down recently over the Christmas period, the Christmas New Year period, into extremely tight market. All the properties available for purchase would turn over in 50 days in this market. On a national level, this is extreme tightness. We're seeing similar examples up in the Brisbane market as of today. Some parts down here in Hobart. This is a market which has a tremendous amount of heat in it. All right, people are running into properties and they're going, offer over offer scenarios. They're just making their best offer first and hoping, fingers crossed, that we land a property. They're getting desperate. They are wanting to buy. This is a market that we expect to grow in the short term quite strongly, but we might also potentially have already reached a short-term market top in this area. Right, and what I mean by that is it's all of these signals are combining to say, hey, the buying window is probably well and truly closed here. Very similar to Brisbane. I don't want to get involved in this market that has this amount of heat in it. Percentage above asking price. So here for houses on the blue line, we are now seeing a property listed for $1 million, selling for, what's this, 1.14 million. All right, so the sales agents don't really have a clue what's going on. The vendors don't really have a clue what's going on. They're having a conversation, let's list this property for $1 million, and then it ends up running away and selling for 1.14 million. All right, so this is a market where the sellers have a tremendous amount of benefit and they're receiving the upside. The buyers are having to scramble. They're having to compete against each other, and they are having to set, where a property lands or ends up. The vendors and the sales agents really don't have much of a clue about what their properties are really selling for. This is an environment that typically to get to this point, you've got many offers going onto a property. Just think about it. You've got 50, 100 parties going through open homes. You've got multiple offers being received in the first day after an open home. People are having to remove a lot of conditions from these properties, not subject to finance, not subject to building and pest inspection. All of the usual buying considerations that protect a buyer are being removed because no one has any leverage. And then you've got these offer over offer scenarios. People can see you have 50 people in an open, so they know they have to lead with their best foot forward. It's not like we're going to submit an offer here and test them out. We'll make them sweat for a week or so. They're coming in here with the absolute maximum budget they could potentially afford, and they're leading with their best foot forward. This is when you start seeing gaps emerge in the market, where you have one party who potentially has made their best offer forward. You've got no information gathering that's possible. You can't fill out the property and the other buyers and make another offer $10,000 above. You've got to just launch forward with your best offer, and we start seeing separation. We start seeing gaps up in these properties, and then you start seeing other properties now filling in those gaps until you have another gap up. And it might not happen on every property, but those nicely renovated owner-occupier properties, the best properties in the street type properties, they are the ones that generally gap the market, and then you start seeing all the inferior properties fill the gap, and then once again you start seeing it rocketing off. This is an environment and phenomenon that we will be seeing in this market as of now, and something that as a professional investor, we would stay well away from. Okay, you haven't done your job if you hear about Adelaide and then think it's a hot market, it's running away, let's get involved. Okay, you haven't sort of dug into things deep enough. Right, we haven't, it's not enough necessarily to listen to a storyline and look at all the positive aspects of Adelaide, look at a market running away like this and going, great, I've found my area to invest. No, you haven't. You're 3-6 months too late. All right, so I'm not trying to be a negative, take a negative perspective here, but really we don't want to get anywhere involved in this type of market. We are dramatically too late into the Adelaide market. It's extremely difficult to buy properties there. is the buy side. The buy side's pretty clear to me. Is this reiterated by the rental market? Okay, days on rental market, so this is how quickly a rental property is turning over. It has been generally pretty consistent, slight trend line upwards, still a very effective market, very low vacancy rate. This is around a 2% vacancy rate, if not slightly below. This is not really telling me much. It is a slight trend line upwards, which is demand evaporating from the rental market, but nothing really there that's jumping out at me in terms of this, a strong signal, I guess. So let's just reiterate there with the vacancy rate. This is where we really are starting to see. So probably just digging into this a little bit deeper. When a property is listed for rent, as we saw on the previous slide, it is taking around the same time to lease. Okay, and that's generally coming down to a market having to go through a process, once again, open homes, people vetting references, going through that process of leasing. But the actual vacancy rate at the same time has been dramatically tightening now to under 1%. All right, so that's telling me that even though when properties are listed for rent, they are still renting in a similar time, there are far fewer properties to rent. All right, so there's more people falling over themselves to rent these properties. It might be a symptom of unemployment. It might be people, piling into the rental market, in preference to buying through this period of instability. But we have an extremely tight rental market. Typically, that does lead to another cycle of price growth. All right, when you do see it. But, sometimes, and you'll see in a moment, we've already seen a pretty strong cycle the last 3 months, 6 months. So I don't know if this has the steam to push the buy side for the fourth. Weekly house rents, tight vacancy rates has been resulting in an upwards trend in rental prices. So we're now heading up towards $400 per week average in this market. That's generally around a 4.5% yield in this market. This really hasn't changed. We were buying very actively in this market 18 months ago, right, to the tune of 100 properties in 2019. We were getting 5.5% yield at $380 average for a 3-bedroom home that we're picking up for $300,000, $320,000, $340,000. So we're walking into those properties with a 5.5% yield. In the last 2 years, we've only really seen rents creep up now towards $400. And we've seen yield compression. Price growth, as you'll see in a moment, has really rocketed off. We've seen yield compression. The yields have not kept pace. All right, so generally we see this back and forth dynamic where rent side pressure drives buy side, where that rental pressure has definitely dissipated. We've seen prices growing far more quickly than rental price growth, and so then yields are dropping. It's just a very simple equation. When yields are dropping, you've got less investors active in a market, and you've got a big chunk of buyers who are just not as active, not driving price growth. All right, so that's how that flows through. So we have seen the steam dissipating in the rental side of the market, and you can see this now finally reiterated on the rental yield curve. So we did even start off 12 months ago at 5%. 12 months before that, it was even slightly above this. And now we really have, the middle band here is the median. We really have started to see median rental yields dropping down to 4.5. All right. This is a symptom of a market that's growing and rents not keeping pace. All right. So let's just jump across. And now this is why, this is now tying it all together. We can see prices here, 2019, 2020. This is when we were buying in this market. And I'm not saying, hey, we were right, okay? But, it wasn't by accident we were buying in this market. It was only one of 30 or 40 different suburbs that we were buying in at the time nationally. But this is when we had tremendous rental pressure. And we hadn't had the price growth. Yields were through the roof. We had extremely high demand. We had very limited supply, and we had very strong rental pressure. Well, guess what? We've had a tremendous amount of price growth, almost 50 to 60% price growth in that time. What is the strongest handbrake on future price growth? Now, you can add it into the comments if you'd like. It's not rocket science. It's previous price growth. People can't afford to pay $500,000 in this year, or less people can, all right? So higher prices are a very strong determinant of future price growth. Less people can afford to pay those prices, less people are then able to buy, and so prices start to slowing down. It's our number one metric. It's our strongest correlation to future price performance is previous price performance. This type of price performance is a big handbrake on future price growth. And we can see that now when yields are not keeping pace. It means that properties are now too expensive. People will then move back into renting properties. Because the rents haven't kept in line with the price growth, it's now far cheaper to rent in the area. People will move back across into renting. And that dissipates all of the pressure in the buy side, on the buy side. So we want to make sure that we time this right. I don't want to be coming into this market now. South Australia more broadly, or Adelaide, sorry, more broadly. I don't want to be coming into this market and the heat evaporating as I enter it. We need to get our timing right. You know, there's arguments to be made that we could have been purchasing in 2021. We were trying. And as professionally, we could not buy there for ourselves and for clients. Okay, we couldn't land into properties effectively when we have leverage, so we didn't. We didn't force it. We were off in other areas. Now remember, I guess we are a national buying company. We're buying hundreds of properties every year for ourselves and other clients. Property advisory company. If you'd like some assistance in buying remotely in other locations across the country, you might be in Sydney and Melbourne and you'll be interested in buying, say, in Perth or even in a regional centre. We can definitely help and assist in doing so. Please, if you'd like to take a next step there, book in a consultation. We're happy to put together a wealth plan for you at no cost and run through potentially how we might be able to work together if we are a good fit. So take that opportunity if you'd like. We would like to focus maybe on the next video in a market we are buying in. Okay, we've now done the Perth market where we are buying in. We went into Brisbane and Coffs Harbour and now Adelaide. These were all user request suburbs. It's quite often the case that a lot of investors are reading the newspapers, looking at the boom times, looking at all the percentage growth in Brisbane and in parts of Adelaide and going, right, this is where I'm going to buy an investment property. Well, guess what? When you invest with the masses, you get average results, and average results are not particularly good. We want to beat the masses. We want to be first to the punch and get into these markets first. So in the next video that we'll release as a market observation, we will be focusing on a market we are buying in today. We're not hiding it behind a paywall. We're not hiding it behind a curtain where you have to engage our services to find out where we're buying. We're going to put that part of the industry to bed. We're going to be talking about the areas that we are focusing and buying right now for clients and take a deep dive there. So thank you.